All right, guys, let's go ahead and get started. It's 4 o'clock. Yeah, first I want to say good afternoon, everybody. My name is Brian Reese, certified financial planner with CKE Financial Services and Raymond James. And thanks for joining us for our Q2 2024 quarterly market update. And as a reminder, we do these each and every quarter, just really to keep our clients informed on the current economic issues, and then review the quarter behind us and preview the quarter ahead of us as well. Also want to remind you that today's call is being recorded, and you can watch the replay. If you miss anything, don't understand something, you can always watch the replay on the CKE Financial Services YouTube page. And if you're not yet a follower on the YouTube page, go ahead and jump on there, click follow, click like, and enjoy the content that we started creating and putting out there. Any questions that you may have throughout, just if we have time, we'll get to them. But if not, you'll see our emails and phone numbers in a minute. Make sure you take note and reach out to one of us with any questions, concerns, comments, anything you need help with. So with that, we're gonna get moving here. Let me click to the next. There we go. I knew I'd get there eventually. CKE Financial Services is a full-service financial planning firm in Crocker Park, Westlake, Ohio. We work with individuals, families, endowments, trusts. We work with businesses, business owners. We manage over 70 retirement plans at this point. And joining me on the call today are Ryan Eierman and Scott Jones. Tim Eierman and John Lippi round out our advisory team, and then Davia in the picture, you'll see Davia, Julianne, and Tanya, and they kind of keep the office running for us. And if you've worked with us for a while, you've probably worked with at least one of those three as well. So again, here's a chance where you can take down if you don't already have it, take down our phone number and or our email in case you've got any questions. So I'll leave that up there for a couple seconds longer, just so you have time, because I don't think we've got this at the end. Okay. And on this screen, you see an overview of services. So, whether you're a 401k plan sponsor or participant or just a regular old client, you can look through here. The main thing I want to focus in on is the additional financial planning tools. So just to let everyone know, most of our clients, we do start with a financial plan and kind of get a baseline of where someone is. So if you haven't done that with us yet, or if you want to have a financial plan run, we can do that. But we also have more module related tools that we use with clients. So if you have questions on Social Security, college savings, converting money to Roth or Roth conversions, life insurance needs, any of those sort of things, we can help you out with a shorter module. It doesn't have to be a part of the full-blown plan. And then all of our services, we are either able to help you guys over the phone, via Zoom, or in person here at Crocker or another location. So now with technology, we're able to help clients out in a variety of different ways. But reach out to us if you, again, need assistance on updating your plan that you already have, if we haven't done that in the last year yet, let's say, or if you haven't done a plan at all. So just reach out to Scott, Ryan will give you a hand with that. The way that this next 25 minutes or so is going to flow, I'm going to start with the market update and review the key themes. I'll turn it over to Ryan to talk about the stock market outlook. Scott will then go through the bond market and review the fixed income portion of this, along with the hopefully a reminder on the importance of diversification. And then at the end, Scott will turn it back over to me, and I'll let you know what the upcoming Medicare presentation is. A little hint: it's Medicare related, and it's going to be in September, both in person in Crocker Park and on Zoom, whatever's more convenient for you. So where have we been in the stock market? Remember that now we're 22 days into July, so this is all end of Q2 information. So remember, second quarter review. So how did the markets do? Well, we've got the Dow Jones Industrial Average. It was up 3.79% in the second quarter. Over the last 12 months, that puts that return at 13.69. The S&P 500, and that's the one that that's the 500 largest companies in the U.S. economy, and that's the one that most people turn to as an overall gauge of how the stock market's doing. The S&P was up 14.48 in the second quarter, or 22% over the last 12 months. And then the more technology-focused NASDAQ was up 18% in the second quarter, or 28% over the last 12 months. Now, in this column, we've got the as of 6/30 numbers. All three indices, the Dow, the S&P, and the NASDAQ, are up from the end of June, which means the month of July has been a positive month in all three indices. Down a little bit lower on the page, the one that I look at is this 30-year mortgage rate, the second from the bottom. It's ticked down a little bit as high as interest rates have been when taking out a mortgage. As high as interest rates have been, they've started to come back down ever so slightly, but 6.99 is what it showed at the end of June. So very slight, but coming down, which, is a separate conversation, but as interest rates come down, home prices probably go up. But anybody that got locked into a 2.5–3% mortgage a few years ago is still looking and feeling pretty good at this point. Gold, further down towards the bottom, gold second quarter return a little over 12%, and then crude oil up about 13, closer to 14% in the second quarter. So strong returns so far this year. Ryan will touch on a little bit more as far as how much more we may have to go, but I'd like to think most people's accounts, if you're well diversified, have probably done pretty well. Scott will hit on the fixed income and how a change in interest rates, when that happens, can affect the fixed income part of everyone's portfolios as well. As far as the key themes that we and Raymond James have come out with for the second quarter, interestingly enough, the first one on the list is the election 2024. It says election 2024, prepare for a sweep. Well, the reality is, now that we know that Joe Biden's out of the race, so the language is going to change. It should change in there a little bit. Its first step is who's going to be the Democratic nominee. And then what does the race turn into? The one thing that we know historically is uncertainty in the market causes trouble. Now, eventually, whoever gets elected, once that happens, usually things settle down, because then you settle into the new administration, and policies and everything gets kind of settled. But that's obviously something that we're all keeping an eye on. That's from the stock market perspective, but also just as a citizen of the United States. So that's an important one. Second one, beyond demographics, if you've seen any of these headlines or done any reading on this, birth rates are trending lower and lower in the United States, generally worldwide. But why does that matter to us here in the United States? Well, if there's less working people in the next 15, 20, 25 years, that means less people are paying into Social Security. So something will have, it's one example, but something will have to give when it comes to that, because if you've got less people paying in, changes need to happen to make sure it remains a viable system. So again, demographics are an important one. Artificial intelligence and electricity, quick on that one, is just the simple fact that as AI grows, and the usage grows, the expectation is energy demands grow along with that by about 3% a year, 2.8% a year. So it's just an interesting thing. Computing power needs to grow, AI grows, electrical consumption is going to need to grow. And the reality is it's been fairly flat for a long time. So this will be a change on that side of it. And then the fourth point is with small caps. Large companies have, and if you've been on our past calls, large companies have dominated the returns the Magnificent Seven. So technology companies, the Metas, Apples, Googles, all of these companies have done really, really well. Stocks have done really, really well, while small company stocks have lagged behind. Well, normally in an interest rate environment where rates are going down, typically small cap companies perform better. Now, I'm not saying that we need to make changes to portfolios to try to play that. That's another reminder of staying diversified and making sure that you have some small cap exposure in your portfolio, along with the large companies that have done really well. So those are the four themes that we're running with at Raymond James and keeping an eye on for all of our clients. And then Ryan, I'm going to turn it over to you for some of the key themes in the stock market overview.
All right, thanks, Brian.
Yep.
So I'm going to start off here by talking about inflation, and particularly what we've seen in the past couple of years here. This chart goes back all the way to March of 2021. And this is just looking at specifically the non-seasonally adjusted inflation, which just means sometimes they will account for periods during the year where, for example, like travel is particularly high or energy prices are particularly high, and they'll adjust for that. But this is just purely the CPI data that we're looking at here. So if you look at summer of 2022, you can see we peaked at around 9.1%. And you can see that the majority of, or a good amount of what made up the inflation at that point was energy and core goods. And then as we move closer to today, you can see that it's trending a lot more. The trend is downward. However, we're kind of stuck at this 3.4 to 3.3% here. And we're seeing that a large amount of the inflation is now made up of mainly housing costs, auto insurance, and dining and recreation. And one more thing on this slide is this is one of the major reasons why the Fed is reluctant to start decreasing rates, because this inflation number has kind of been sticky here the past year, and their ultimate goal is to get that to be about 2.2%, which they haven't quite been able to get there yet. So that's just one of the reasons why they're kind of delaying on lowering rates. Moving on here, this slide looks at equity performance during election years in particular. And what we're seeing as far as 2024 goes is, if you look at that chart on the left, the first half of 2024 has been the fourth best start for stocks during an election year, going all the way back to 1928. So a really positive start for the equities market. And then if you look over on the right, you'll see that in years similar to this one, where equities start off the year strong in an election year, they typically tend to finish out the year pretty strong as well. So for example, like in 1996, you can see that the first 5 months of the year, equities had returns of 9.7%. And then the final half of the year, they finished strong with a 12.1% return. So overall, we're expecting good things from the equity markets to finish out the year here. Moving on, this is another one of our favorite slides to share. These are the returns from the S&P 500 going back to 1980. If you're not familiar with S&P 500, it's just the largest 500 publicly traded companies in the US stock market. And the gray bars across the top represent the final year returns for the stock market, where the stock market ended the year basically. And then the red dots along the bottom, that's the low point for the market during that year. So this one's really just showing the value of a long-term perspective when it comes to looking at equities. And you can see that, even though every year there's a major sell-off, the markets tend to finish positive. And if you look back to 1980, you can see that 75% of the time they do end up finishing the year on a positive note. And then year to date, if you look over to the right, you can see we're currently at 14% returns as of the end of second quarter. Moving on, sell in May, go away, is a old saying that a lot of people have used, particularly earlier on in the investing world. Just kind of means that the stock market typically doesn't do as well during the summer months between Memorial Day and Labor Day. But if you look at the data going back to 2009, we've seen that it's not particularly the case anymore, and that we've seen an average of 3.7% during the summer months. So just another reminder of staying invested, even when things get a little bit volatile. And then the final thing I'll touch on here is, if you look at the top right number, that's our year-end prediction for the end of 2024. And that's from our Chief Investment Officer at Raymond James. And then also there's the 12-month number. So our prediction for what the S&P will be at the end of June 2025. And if you looked at the S&P 500 today, you would see that it's already at 5560. So we've already passed that number. And so we are expecting that there is a possibility for the markets to flatten out here towards the end of the year. And then this is just a few reasons why we think that might be in the cards, but it's not necessarily something that's going to happen. Just a few things to consider. So number one is investor complacency has been particularly high lately. Number two, the slowing economy is starting to hit businesses, and we've seen a slower labor market. We've seen, with the interest rates being high, that means higher borrowing costs for businesses. We're seeing lower consumer spending in particular sectors. So we're going to start to see that hitting businesses. It's an election year is number three. That tends to increase volatility towards the end of the year. And then number four here is referring to the chart on the left, which this chart is looking at all the bull markets we've seen going back to 1949. And as you can see, all the bull markets going back to 1982, we typically see anywhere from 5 to 8 pullbacks during a bull market. And so far since 2022, our current bull market that we're in now, we've only seen 4 pullbacks so far. So that's just kind of saying we might be due for a slight pullback here. And then with that, I'm going to pass it off to Scott, and he's going to touch on the fixed income markets.
Awesome. Thanks, Ryan. Appreciate it. Hopefully everybody's having a good summer. So just going to give a quick update on some bond markets, bond investments. Things have been pretty uneventful here, at least for this year. Year to date, the Bloomberg U.S. Aggregate Index is down about 1%. And it's been a difficult place for conservative investors, particularly retirees who need a lot of income from their fixed income investments. We're looking at about a 5-year return of about 0 right now. A lot of that had to do with the 2022 decline. You can see there on the far right of the chart is down 13%. But this typically has returned positive gains 43 of the last 48 years. So it's been like I said, it's been somewhat challenging space, but I think that will likely reverse course here as the Fed considers cutting rates. There's been a lot of conversation about that. Ryan touched on the fact that inflation is not where they want it to be still. So there's a lot of people still expecting maybe 1 or 2 cuts this year. And that when that happens, that'll be a more positive environment for bonds and fixed income investors. So this chart is just showing you what the potential impact of that could be. There's a lot going on here, but I'll just kind of over on the far left here, you see these are the current yields of different types of bonds. You've got U.S. Treasuries at 2-year at 4.71% currently. This U.S. aggregate 5% is traditionally what we kind of refer to as a bond index and your typical bond mutual fund category. So 5% current yield on that. But if you look over on the right, what would happen if there was a 1% rise or fall in interest rates, what the total return would be. So when you add the yield that the bond pays plus the price appreciation from the rate drop, that would be the total return. You have, for a 1% decrease in rates, potentially about 11.1% total return for the next year for that type of bond. So, a lot of these, we're not saying necessarily that rates will drop 1%, but I don't think that would happen all at once. But over time, a couple of rate cuts over the next year or so, it could be a fairly attractive, almost you could argue stock-like returns in that environment. So just something to keep an eye on. And, I think people are getting somewhat frustrated maybe or discouraged with the results with fixed income, but, you have to kind of look at the current environment and look where things are going for the future. So, and as Brian mentioned, it's very important to obviously stay diversified. This is a time where you should consider diversifying, whether that's in your 401k plan or whether you're working with us as an individual investor. This is a quilt page that we show a lot. It just shows the returns annually of each investment asset class or category. And so, it changes from year to year, right? We always say you want to buy low, sell high, and you don't want to chase returns. So taking a kind of a smoother, spreading your money across all asset classes is a better approach towards longer term investing, like retirement savings goals. So, but over the last 15 years, this green box, large cap, 14%, that's what we refer to as the S&P 500 index. It's been about a 14% return each year. And it's, by far been the best place to be since 2009. Even year to date, over here on the top far right, it's up 15%. Kind of Ryan walked through all that. Was the best place, best returning asset class last year. A lot of that, I think, is due to some of the technology that we've talked about in past calls. It's done really well, a lot of growth in those areas. But, you kind of want to just take a balanced, diversified approach. Reach out to us if you have questions. review your portfolios, and we can kind of take a look at that stuff for you. This chart I also think is very important because we're getting a lot of questions about, or comments kind of like, well, I can get 5% in a CD or a money market fund with relatively no risk. But what you do have is what we call reinvestment risk. And so this is kind of showing you, if you had invested in a CD, 6-month CD at the top of the Fed rate hiking cycle, meaning when they're done raising rates, which many people expect that is currently where we're at, that they will start to lower rates. And what would the 12-month return be on the CD, as well as bonds and the S&P, as well as a balanced portfolio? And you can see, except for 2000, every other time you would have a higher return investing in bonds, whether the S&P 500 index, which is the green bar, or a balanced 60% stock, 40% bond portfolio. So, cash is nice. It is nice to get 5% on, relatively risk-free investments. But if you look at 12 months out, historically, you would be better off staying with a balanced approach, or even investing in bonds every time that we've had these rate hiking cycles. So, just something to consider. So we make available in the 401k plans our model portfolios, and many employees will use those, whether it's conservative to aggressive or income to growth. Now's a good time to kind of revisit those and make sure you're in the appropriate portfolio based on your goals and objectives. We also sometimes look at what are called target date funds and target date mutual funds in our 401k plans. And those are age-based diversified options based on a target year that you're expecting to retire and start to withdraw money out of your 401k. So green is good as far as diversification goes. So you want to make sure that you're leaving it up to the experts, and building your own could be somewhat considered risky, red. So, but you're welcome to choose from the individual investments in the plan, but we do make available good diversified options for you. So, and we always have a investor questionnaire that we pass out a lot of times. If you don't know where to get this, you can contact us. We'll be happy to email you one or go over it with you. But basically, just a good time to reassess your risk tolerance, as far as not only your risk tolerance, but how many years you have until retirement. So our risk investor questionnaire kind of goes through 5 simple questions, and you can go through and kind of add up the score. And then basically on the back side of it, it allows you to kind of pick how many years you have till retirement, say 5 to 10 years, 10 to 20 years, or 20 plus years for retirement. And then effectively you add your score with the time horizon, and then you come up with a portfolio for you based on what's appropriate for you. So again, it's a good time to be looking at that, given everything that we just discussed. All right, so Brian's gonna pop back on here, and we're gonna wrap up, but we do have an upcoming Medicare presentation that will be available for everyone.
Yep. Thanks, Scott. Yeah, Scott said we've got the Medicare seminar coming up. It's really an informational seminar. We started the kind of this process by doing the Social Security seminar a month and a half ago. Some people joined by Zoom. Some people came into our office for it. This is step 2, specifically Medicare. And it's really open to anyone that wants to learn about Medicare, but most importantly for people that are, I would say, 64 and older. So 64 meaning you're getting ready to get on Medicare at age 65, or you are already 65 or older. Open enrollment's coming up in October. So if you're already on Medicare and you're not sure if you're in the right plan or want help picking the right plan, you can attend our webinar, and then we can always connect a client with a licensed Medicare specialist here in Ohio and here locally, actually. So if you're interested, make sure you reach out to us. It's Wednesday, September 4th. The Bagels and Coffee kind of meeting starts technically at 9. We've got 8:30 to 10:30, but 9 to 10 is the time slot. You can RSVP by calling into our office or by emailing one of us. We'll get you on the registration. But again, even if you want to register and just attend by Zoom, that's completely fine. But we find that this and the Social Security are the most well-attended seminars that we ever do, because most people have some confusion about one and or both of them. So we encourage everyone that wants to join, reach out, and we'll get you on the list. So that's the Medicare, and invitations will be coming out in the next couple of weeks. So plenty of time to RSVP for the September 4th. I mean, heck, that's after Labor Day. Hard to believe, but after Labor Day. So all of our information, hopefully you've got that by now. I want to make sure we get our disclosures up in case legal is watching us here. But with that, we want to thank everybody for attending. Again, questions, comments, anything you need, let us know. We'll be doing this again in 3 months. Hopefully the third quarter is as strong, as good as the second quarter. We appreciate everyone's time, and have a great week. Thank you.